and welcome to the Carolinas Luxury Real Estate Podcast, Season 5. For all those new to the podcast, please feel free to follow the link in this episode to our past seasons and explore all the great luxury real estate content. On today's episode, we are talking about the 2022 Fall Luxury Markets Report for Charlotte, North Carolina. I'm your host, Sam Sparks, and joining me to discuss the Fall Markets Report is Reed Jackson, the managing partner for Ivester Jackson Distinctive Properties. Thanks for joining me today, Reed.
Thanks for having me again, Sam, and always fun to talk about what's going on in the dynamic Charlotte market, for sure.
Absolutely. We're always glad to learn from you and hear how things are starting to go and keep going. All right, well, let's go ahead and jump on into it. So with all the talk about real estate markets slowing down, how has the last quarter or so been in Charlotte?
Well, I think it's, going contrary to what you might read in the Wall Street Journal. I know about a month ago, the Wall Street Journal ran an article headlining that the luxury real estate market across the country was crashing, which, was a very skewed report. There are certain areas of the country that are not only not crashing, they're actually on the uptick. And so Charlotte in certain price ranges has seen not only no decline, but is actually having historically good sell-through this year. So I think, certainly in interest rate sensitive price ranges, as you drop below $1 million and certainly down into the 500,000s and down towards first-time home buyers, the market has definitely been impacted, 20 to 30%. In terms of sell-through, but fortunately there was fairly low inventory in those ranges as well. So pricing stability has actually held up even in those ranges where the sell-through's off.
Oh, okay. Interesting. Reed, are you noticing differences between the different price segments under $1 million, that million range, and over $2 million?
Absolutely. Yeah. We've seen in terms of both sell-through and showing activity, and those things tend to run together. Showing activity is kind of a precursor to, contracts being placed. And so what we've seen is in the range, well below $1 million, showings have been off most of the year, certainly since the Fed kicked rates up, and the financial industry, jumped ahead of that. So I think we've also seen as you crest $1 million and you start to go to a sales mix that's maybe a little less mortgage heavy and a little more cash heavy, most of the deals below $1 million are going to involve a mortgage. As you crest $1 million, that number starts to drop down closer to 70, 60%. And then when you get up over $2 million, over 50% of the deals in our area are cash. And so they really haven't been very sensitive to interest rates, particularly mortgage rates, going up. That end of the market tends to be more driven by the financial markets. And so, even as recently as this morning, the Dow's trading at about 33,500, which is within 10% of its all-time high. And so you've got all this liquidity that's been created over the last 10 years, and there people are comfortable moving into hard assets like real estate.
Yeah, makes sense. So how does the market's activity look right now compared with last year's activity at the same time?
So, very interesting question. Most people would assume that it's lower than last year. The two pandemic years were historically good years in the Charlotte area. And I think many of us anticipated that moving into the fall here, we'd start to see some tapering. We've seen some seasonal tapering compared to the summer, but if you compare it to last year, in some of the price ranges, as you climb up, $1.5 million plus, $2 million plus, we're actually still seeing showing activity exceeding last year's fall activity. And so just this morning, you're looking in the 2 million range in Charlotte. Showing appointments over the last 30 days exceeded last year's mid-October, November level by about 20%.
Wow. Yeah. I mean, based on what you're seeing in the news and online, you wouldn't suspect that.
No, you wouldn't. And that generally, is a prelude to pending contracts. And so, if you look at the showing activity between October 1st and say mid-November right now, running, let's say 20+% ahead, it certainly points to contractual activity that will probably be on par with last year's end of the fourth quarter, maybe even better.
There you go. That's good news.
Well, I think it's probably surprising to people that are reading, national media reports. I think, we operate across the state, and in almost all of our markets, the upper end price segment has fared as well or better as it did last year, which is really surprising, but certainly a function of how appealing North Carolina is, and the ability for people to work remotely, and some of the new dynamics.
Yeah, no, that makes sense. Now, on the luxury front, have increased mortgage rates impacted some buyers, and what percentage of deals are cash offers?
Yeah, so I think you are starting to see a little bit of slowing and hesitancy in the million range. I think at that range, right around $1 million plus or minus, a couple $100,000. I think that's a little more interest rate sensitive, and so we have started to see a little bit of tapering, since probably early September. And so I think as you push up higher above those price ranges, we really haven't seen that much of an impact. I think with the ultra luxury range over 2 million and 50% or more of the deals being cash, I think that market has been very resilient, and actually, very high activity levels. I think people at that price range are still very liquid and capable of buying higher priced homes, but they are asking more questions, and they're certainly doing more due diligence while they're looking and evaluating homes.
Right. Yeah. I mean, that's what you have to do to buy in this market. So are you starting to see increases in inventory, and how do those levels compare to historic levels pre-pandemic?
Yeah, so there's two answers to that. Obviously, yes, we are starting to see some inventory run up, but we were at such acutely short levels that we still are nowhere near where we were even in March of the first pandemic year. And so I think until we get back to those type of levels, I don't think you're going to see much pricing instability, because there's just not enough inventory to create desperate situations that lead to big wholesale dramatic price reductions. I think we talked earlier about how there's a difference between a price decrease off of a high initial price that is well above the previous year's comps, versus a price that's lower than the previous year's comp. So I think what we are seeing, the second half of this year is, the ability to price your house 20% higher than what your neighbor got 6 months ago. That's certainly, definitely tempered. But I do think we are still going to see year over year slight price increases in this market over last year's closing prices, all the way through to probably January. I think third quarter showed a single digit to low double digit price increase across the mid to upper level luxury ranges, and I think we're going to see another slight price increase compared to last year, although it's definitely starting to taper and flatten out.
Right. And obviously, we know that houses are on the market a little bit longer right now. Instead of, being sold in less than a month, they're looking at, 2 months, but that's not helping with inventory, you're saying. There's still little inventory.
Well, what's happened is we've seen less houses come on the market than came on last year. And so that's one of the if you're looking at it as a homeowner and prices or price stability, one of the saving graces right now is that I think people, their basis on their homes over the last couple of years after refinancing and buying in low at lower rates, there isn't as high a level of motivation to come on the market right now. So the number of new listings coming on the market at this time of the year compared to last year is off about 11%. And so you have less houses coming on the market at the same time, you've got some buyer deterioration. And so those two things are kind of canceling each other out when it comes to price stability. There are less people chasing, but there are also less homes coming on the market. So inventory is staying very low in a lot of price ranges.
Right. Okay. So what variables will impact the luxury real estate activity moving into the first quarter of 2023? And how is that looking?
Well, right now, if you look at showing activity, particularly as you crest, 1 million, we're probably running similarly to last fall, lower in the lower ranges, but also not as many houses coming on the market. If you look at the ultra luxury range, showings are actually running a little ahead of last year at this time. Total showing requests, because there's a little more inventory to see, are higher, and that's explainable. But the average number of showings per house, is about the same. So that means even though there's a little more inventory, the houses are still getting shown about the same amount in terms of frequency. So I think that points to, in the ultra luxury range, a little bit more of the same moving through to January. Wall Street seems to like the result of the midterm elections and the fact that we're starting to see, some glimmers of, high inflation numbers starting to possibly peak out. But we're not seeing much downturn yet. So I think we're still in for a couple Fed increases. But I think if we start seeing a little bit more, decline in CPI numbers and producer price index numbers, I think that's actually going to help housing, because I think the financial services guys will respond with lower mortgage rates, and then I think the shock of being at 6.5–7% is going to make 5–5.5% relative and more appealing than it was on the way up.
Right. No, you're right. Absolutely. I know there's a lot of people out there monitoring those interest rates very, very closely. All right. Well, once again, Reed, thank you so much for joining me today and talking about Charlotte's 2022 fall market report. It was great learning from your experience and picking your brain.
Yeah, thanks again, Sam. And as always, it's been fun to talk about our great real estate markets here. And we'll look forward to catching you next quarter.
Absolutely. Sounds good.
All right.
And if anyone wants more information about the firm, you can visit us at ivesterjackson.com. Thank you so much for watching. Take care.
All right, thanks.